Philip Shaw joins us now, certified financial planner from Goldstone Financial Group. Philip, thanks for joining us today.
Thank you for having me, Wendy.
I am going to tell you something, and I hope this isn't a lie. Tax day will be here before we know it. We get a lot of our pay stubs and things very early in January. I am making another vow to get things ready by the end of January. Do you believe me?
I believe you, but I wouldn't anticipate you'd have everything, especially if you have 1099s coming, any kind of investment accounts, probably middle to end of February. But I like your optimism.
Well, that's all it is optimism. I pretty much have lied to you because every year it happens the same time. I say by the end of January, early February, I'm going to have everything ready for my accountant, and it's usually either filing for an extension or I get it done very late in the game. And there are new tax changes and tax laws. What has changed for this year?
Yeah, so there's a few things that'll affect you on your 2022 tax return. And especially going into 2023. So they have capped the child tax credit. There are some deductions for 2022, such as $300 charitable deductions or $600 charitable for joint filers. That's all going away this year. So a lot of changes, really more so for 2023 than for 2022. But good to know when you're planning going forward. And that's always my encouragement this time of year is it's not just about, getting everything together and making sure we're ready to file taxes, but making sure we're ready for the year going forward. Do we need to be making any changes? Do we need to be planning for anything different other than just, reporting what's already happened?
All right, you have a child, they're your dependent. What are the ages on these kids? And what if they still live with you when they're in their 30s?
It depends if you can qualify them as a dependent for you, which is a calculation around how much of their expenses you're covering. And that's really a little more in the weeds. You should look into your own situation on those. But just do know that some of those have been capped for this year. If you were expecting, a larger tax credit than you've seen in the past, they have been capped for this year.
All right, and charitable deductions. I am trying to declutter. I have made several, probably 15 trips to Goodwill at this point. I'm getting receipts and I'm itemizing everything. What has changed in the charitable deductions category?
Well, going forward, the only charitable deductions you'll be able to actually deduct are if you're itemizing deductions for taxes. So in the last 2 years, you've been able to itemize deductions. But even if you were taking a standard, you could deduct $300 of charitable giving as a single filer or $600 as a married. That $300 and $600 is going away for 2023. So the only time you're actually going to see a benefit for any charitable contributions is if you're itemizing your deductions and not taking that standard.
Well, come on, that's not. We need to help charity. Isn't that going to dissuade people from giving charitable deductions?
Oh, most certainly will. Most certainly will. So not every tax law change is going to be a positive, in my opinion. And there have been quite a few, especially just passed here in the last week. So, a lot of changes were made with the Secure Act 2.0, which was literally just passed here in the last, week before the new year.
And you mentioned 1099 forms. If you do freelance work or you have your own LLC, you get 1099s. How is this working with Venmo and PayPal and those similar apps?
So one of the changes that was made in 2022 is Venmo and PayPal are going to be required to send you a 1099K for any transactions above $600. Now, just because you have a transaction above $600 does not mean you need to run out and file taxes for it. This only applies if it's for your own business, if it was income you've generated. If you're paying a friend back for dinner or a plane ticket or, you're paying somebody for rent, that's not something that qualifies. Don't worry about it.
Okay, are there other tax changes we should be aware of for 2023? I know this year we're filing for 2022, but we're getting things organized for next year. What should we know?
So there's a number of big things that happened for 2023. So your contribution limits went up considerably. So your 401k contributions have gone up to $22,500 as a maximum, and if you're over 50 years old, you can contribute an extra $7,500, or a total of $30,000. You can contribute an extra $500 per person to IRAs or Roth IRAs in 2023. So that's $6,500 now, and $7,500 if you're over the age of 50. A couple of big ones especially for people in retirement. Social Security is giving one of its largest ever increases this year. They're seeing an 8.7% cost of living increase.
Okay,
for Social Security.
Philip Shaw's on the line with us. Philip, doesn't that kind of surprise you? Because everybody said, by the time you need to file for Social Security, there'll be nothing left in the pot. This is encouraging, I think.
It's encouraging, and especially for the amount of benefits people are receiving. That 8.7% increase, now, granted, that's really just offsetting inflation, but the fact that they're given an 8.7% increase is going to be a big deal for a lot of retirees. Now, Social Security long-term still has a funding issue. This is an issue for our politicians more than anybody else, as this is a political will issue. I'm not worried that Social Security is going to run out of money. It's just a matter of time until our politicians find a way to handle the issue.
Okay, and tell us about the Secure Act 2.0 that was recently signed into law. How will this impact retirement savers?
So Secure Act 2.0 was signed as a part of the federal spending bill in 2023. The biggest difference right away is it increased the RMD age, the required minimum distribution age, from age 72 to age 73. Long term, they're looking to change that all the way to age 75, but that's not going to occur for another decade. The big thing that people should know is if you didn't qualify for required distributions last year, you're not going to qualify for required distributions this year either. But if you're turning 73 next year, or you're turning 73 this year, be wary of that.
Okay, I am not in my 70s, and the only reason I even know what an RMD was is a family member passed away and left me some money, and I had to continue with her required minimum distributions. But did I really have to? I know I did last year, but how does that work?
If you inherited an IRA or a 401k from somebody and they were taking required distributions, you have to take required distributions as well. Now, this is where I'd say it's really important that you sit down with a financial planner or somebody that can sit and analyze your situation, because there were quite a few changes that were made pre and after the year 2020. So whether you inherited funds 3 years ago or you inherited funds last year, you actually have quite a bit of difference in rules around that.
Okay, and the only reason I bring that up is because, for people listening who aren't in their 70s yet, and they're like, what is RMD, required minimum distribution? How does that affect me? All these things you're talking about can definitely affect you. So thanks for clearing a lot of this up. I don't have to say we're doomed, it'll never work, because, hopefully we'll be okay. Philip Shaw, certified financial planner from Goldstone Financial Group. If people need some help, how do they reach you?
So easiest way to reach us is through our website, which is goldstonefinancialgroup.com. You can find all of our information, schedule times to talk with one of our fiduciary advisors. Anything you need, you'll be able to find there, goldstonefinancialgroup.com.
Philip, really appreciate your information today. Thanks for talking with us.
You're very welcome. Thank you for having me, Wendy.
Certainly.